Welcome. This is John O'Reilly of O'Reilly Wealth Advisors, and we're sharing with you some ideas about the market's response to coronavirus. And if you're watching this, this is being recorded in March of 2020. And if you're watching this in the future because the market's had another decline, the same information I'm sharing with you today is true tomorrow. I'm going to skip this slide on coronavirus because it changes every single moment. And let's go right on to the slides about the market. So this first slide shares with you that after every single market decline, by the way, in the history of the stock market, I just want to think about this statement. In the history of the stock market, there has never been a decline that we did not recover from and then go on to new highs, whether you're talking about the 2008, 2009 big drop, we were hitting new highs a few years later. You're talking about the Great Depression, we hit new highs after that as well. And so what we're showing here is we've just collected some information. This is market data going all the way back to July of 26. We've taken all the, well, first of all, the annualized return over that entire time frame, and I'll put my little gizmo here, is 9.61% over the entire time frame, about 94 years, okay? And so what we show here in this first group of columns on the left is that after a 10% market decline, the 1, 3, and 5-year annualized returns are as shown, 11% plus. In other words, it's showing the proof of the market recovering after a 10% decline. In the middle, 15%. Same thing. We had 9%, 10.5, 10.5. And note that almost all of these are above the 9.6 average. It kind of makes sense because if the market's been down and it's got to get back to that 9.6 average, it's going to have to outperform after the decline in order to get back to a 9.6% average. And then finally, the biggest returns, and this, of course, this is no guarantee, but the biggest returns have been after the biggest decline. So a 20% market decline or more. And the 1, 3, and 5-year averages are as shown. And I fully expect we'll be talking about the coronavirus here. I don't know if it's going to be 6 months, 12 months, or 36 months from now, but we'll be looking back on it, realizing, wow, that would have been a great opportunity to rebalance or put more money into your portfolio. Going to the next one. This talks about the difficulty of trying to time the market, okay? So in this case, we're showing about 29, 30 years of data from 1990 to 2019. And in the total time period shown, 9.96, let's call it 10% return, annualized return over that time frame. And if we missed, going from left to right here, the next column to the right, if we missed the one best day of that time frame, we would have had a 9.5% annualized return. If we missed the 5 single best days, 8.5%. If we missed the 15 single best days, 6.5% return. And if we missed the 25 best days, only a 5% return. And then down here on the far right, we're showing the return of 1-month U.S. Treasury bills, which is 2.7%, which is maybe keeping up with inflation. So this just shows the difficulty and the challenge with timing the market. The only way to get the return in the market is to be in the market. And if people can claim that they can get in and get out and get back in at the right times and make money, they are just dreaming. They can get lucky maybe once, but it's not something that makes sense to do. It's also incredibly stressful because you don't know if you got out at the right time. You don't know if you got back into the right time. Wow, it's really intense. Okay, let's go to the next slide. So this shows the specifically the sell-offs due to viruses. So since this presentation was originally put together for the coronavirus, and we're showing 2 different sell-offs as shown at the top. If you look at the left-hand one, this is a Vanguard slide. What they're showing is, it's kind of interesting. At the very bottom of the trough, right here where my little red dot is, okay, they're showing the difference of if you were in a 100% stock portfolio versus being in a 100% bond portfolio. And the idea here is that if you let the intensity of all the news and everything, the scariness of it, if you let that get to you and you say, John, put me in 100% bonds, then here's what's going to happen to your portfolio. It's just going to kind of trail off to the right, be basically flat. But if you'd be in a 100% stock, kind of the other extreme, and I'm not saying you should be necessarily 100% stock, depends on your situation, but if you did, you would climb back up with the market. And by the end of the year, 1 year since the big upset, you'd have a 30% gain. And really the thing that I'm going to show you in another presentation that you should be able to find the same place you found this one is how rebalancing works. And then in this case, on the right-hand side with the Zika sell-off, same sort of thing. Here at the very bottom of the trough, if you just freaked out, went to bonds, you'd end up with basically flat. And if you'd gone 100% in the stock market, you'd have a 10% return after 1 year. And then finally, the last slide I have for you, don't let this slide intimidate you. It's really not as bad as it looks, maybe, if you're not used to looking at these charts. But the thick vertical columns that are sort of a greenish color, that's the market return for that year. Across the entire year, that's the market return. And as you can see, the vast majority of the years, the market is up. There are a few years down. By the way, the long-term average on this is it's almost perfectly a three out of every 4 years, the market is up. A lot of people don't realize that. There's so much doom and gloom out there. I think we tend to think that it's probably as much down as it is up, but actually it's up 3 out of every 4 years. And that's one of the reasons why it's a great builder of wealth. And so if you look, for example, right here, this is the .com era right here. For those of us who remember the early 2000s, this is the 2008, 2009 Great Recession, as it's referred to sometimes. This is the early part of 2020 when the market started to go down. So that's one thing. Okay, so the first thing to get out of this slide is that the market is up most of the time. Now, the second thing to get out of it, if you look at the bottom of these 3 different parts of the data, the bottom one here that I'm underlining right now, the largest intra-year decline. In other words, within each year, what was the largest percentage decline? And I think this can be kind of surprising because, as you can see, by the way, that's the kind of rust-colored one, and it's going down. You know, it's a decline, so it's going down below 0. So it's these skinny lines that have a little endpoint on the bottom. So if you look across this 29 years or so, it's, I thought, kind of surprising when I first saw it. Not too surprising since I'm in the business, but I like the way they showed it on this slide. You can see that, gosh, I'd say the average is probably about -10, maybe even close to -15% inter-year decline. So declines during the year are completely normal. It's just that we don't always notice them. But there's declines happening. Now, sometimes they're small and sometimes they're big, but they're pretty consistently at least, 10%, I'd say all the time. So this is your data to help you get over the concern. I mean, it's a natural thing that when the market declines a lot, you get a pit in your stomach. And even I get a pit in my stomach when it happens. It's not fun to watch, but I know that it's not only going to recover, but it's actually going to eventually go on to new market highs. And so if you can try to rein in your emotions and try to look at that data and help yourself, realize that you're only thinking about this moment in time. And in a year or two, you'll be looking back at this time thinking, wow, that was a scary time, but hey, we're doing fine. And if you're currently working, putting money in a 401k, this is awesome because when the market goes down, you're getting a bargain. So think about it that way. Anyway, that's all I have from here. This is John O'Reilly of O'Reilly Wealth Advisors, and have a wonderful day. And I will stop this recording momentarily.